Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we are looking at Beyond Meat.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And just a quick heads up before we get into it, you can check out the description for a 14-day trial link to StockOracle.
Yeah, just a full disclosure, that is an affiliate link. And remember, AI insights and value estimates from any tool can be wrong, right? So always verify the data yourself.
Exactly. We are focused purely on long-term wealth building here, not short-term trading.
Right, and we definitely do not give financial advice or tell you to buy or sell anything.
So with all that out of the way, let's jump in.
Yeah, let's do it. So next time you are walking down the aisle at your local grocery store, pause for a second when you hit the meat section. Look at those familiar green packages sitting there right next to the ground beef. Beyond Meat.
We have all seen them. Most of us have probably even tried them at a summer barbecue or something.
Totally. Usually, when we look at those packages, we are just thinking about dinner. But today, for this deep dive, we're going to look at them as a real-time, high-stakes masterclass in corporate survival.
It is genuinely fascinating. It's a phenomenal psychological shift. Watching a company transition from the boundless hype of a revolutionary product into the cold, unforgiving reality of public market balance sheets.
Yeah, clearly.
The narrative goes from changing the world to just making payroll.
Yeah, which brings us to their wealth-building thesis, or I guess right now, their wealth preservation thesis. We are taking a highly critical, valuation-aware look at this brand because they just executed one of the most desperate moves in the corporate playbook.
Right, the reverse split.
Exactly. On August 13th, 2026, they pulled off a 1-for-30 reverse stock split. Now, we all know that is a purely cosmetic mechanism, right? It's just to maintain their NASDAQ listing.
Yeah, it doesn't change the underlying value of the company at all.
Right. Mechanically, though, it strips away any illusion of stability. I mean, it crystallizes just how devastating the bleeding has been for long-term shareholders.
Exchanging 30 separate $1 bills for a single $30 bill? It doesn't change the amount of money in your wallet, but it does drastically change the psychology of how the market views your stock.
Yeah.
They had to force the share price artificially higher just to avoid being delisted. So the stock is currently sitting at $14.77 post-split.
Which, I mean, that sounds perfectly fine, right? Until you zoom out and look at the chart. On a split-adjusted basis, their 52-week high was $230.70.
Wow.
Yeah. That is a staggering 79.4% drop in a single year.
Yeah.
Your capital protection alarms should be absolutely blaring right now.
Oh, they definitely are. But the mission of this deep dive isn't just to gawk at a stock crash. We went through a huge stack of recent earnings reports, financial analyses, and market sentiment data. And buried in all of it is a fascinating financial paradox. This is where the long-term wealth building aspect actually gets interesting.
Okay, I am listening.
All
But
right.
you know me, I am highly cautious here. What is the paradox?
The paradox is the massive tension between their income statement and their statement of cash flows. So the top line bleeding is severe. For the first half of 2026, their revenue was $127 million.
Which is down, what, almost 12%?
11.6% drop from the first half of 2025 exactly. So people are actively buying less of the product. That's the existing engine, and it is sputtering.
Right. And yet, and this is the part that kind of blew my mind reading the sources, despite revenues falling rapidly, their cash burn is drastically improving.
It's wild.
In Q2 2026, net income actually turned positive to $16.4 million. Just one quarter prior, in Q1, they lost $28.5 million.
Which is a huge swing.
And it gets better. Their operating cash flow for the first half of the year improved from a negative $58 million last year to a negative $23.2 million this year. So wait, they reduced their cash burn by roughly 60% while literally selling fewer burgers.
Yes. And see, the market rarely prices in nuance during a panic. And the panic around Beyond Meat is deafening right now. But underneath that noise, management is pulling off an incredible feat of corporate dieting.
So they are cutting costs to the bone.
Exactly. The lesson here is about operating leverage. The market looks at the falling revenue and assumes the business quality is fundamentally broken. What they might be missing is how aggressively a company can restructure its cost base to survive.
My brain immediately goes to an analogy here. Beyond Meat is basically a sinking ship out on the ocean. The crew has successfully run down into the hull and patched the biggest hole, which is the cash burn.
Right.
So the water isn't rushing in nearly as fast, and they aren't going to stink today. But the engines, the revenue, are completely dead, and the current is dragging them straight toward a massive reef.
And that reef is their debt maturities.
Exactly.
Yeah.
So to get back to the fundamentals, if the engines are dead, we have to look at why people have stopped buying and where the company's trying to find a lifeline.
Well, when management was asked about the persistent headwinds in U.S. demand during the Q2 call, their primary defense was to blame, quote, misinformation about plant-based products.
Oh, God.
They are pointing the finger heavily at external narratives that are dampening domestic demand. They think consumers are being actively misled about the health benefits.
Yeah, I have to push back on this entirely. As someone who looks at capital allocation, whenever a company's sales tank and management just says, oh, the public is misinformed, my skepticism alarm goes into overdrive.
It does sound like a convenient excuse.
Right. Blaming misinformation just feels like a highly convenient cop-out. It lets leadership avoid admitting a really painful truth, which is maybe people tried the product, the novelty wore off, they didn't like the texture, and they simply don't want to buy it anymore.
I hear that, and it definitely sounds like standard executive deflection. But if we look at the broader industry context, there is actual data backing management up on this.
Really? Like what?
The traditional meat industry has spent millions of dollars on lobbying and counter-advertising campaigns. They are specifically designed to highlight the highly processed nature of plant-based alternatives.
Okay, that is true.
Yeah, they have aggressively pushed this narrative that a beef burger is a single ingredient, while a Beyond Burger is like a laboratory experiment. So while consumer palate fatigue is a very real factor, management isn't entirely wrong that there's a narrative shift working against them.
I mean, sure, but the result on the income statement is exactly the same, regardless of who is to blame. The U.S. consumer is fatigued. The revenue is dropping.
True, but management is reacting to this geographically, which is part of their long-term growth driver strategy. The sources show that while the U.S. struggles, Europe and Canada are actually demonstrating strong growth.
Okay, so that is their international existing engine providing a geographic hedge.
Exactly. This illustrates the immense value of a geographic moat or hedge. A business is incredibly fragile if it relies entirely on one consumer demographic. By leaning heavily into Europe and Canada, Beyond Meat is creating a structural counterbalance.
Because European consumers generally have different dietary trends right now.
Yes, and different environmental priorities, which makes that market much more receptive. So even if the U.S. market continues its slide, that international diversification reduces their dependence on a single challenged market.
It buys them time.
Precious time to figure out their domestic strategy, yes.
But buying time also means they have to cut dead weight elsewhere. While they are growing in Europe, they are making some pretty brutal structural exits. They are actively consolidating their production facilities and pulling completely out of the Chinese market to slash costs.
Exiting China shows a real willingness to abandon corporate ego for the sake of survival.
Because a few years ago, that was the big growth story, right?
Oh, absolutely. 2 or 3 years ago, expanding into China was pitched as this massive, limitless growth narrative for the stock. Retreating from it now is a public admission that they need to shrink their footprint to survive. It's a painful pivot, but it protects the remaining cash.
Okay, so if Europe and Canada are providing a geographic lifeline, why is the company still in such a precarious position? And this brings us to the actual economics of the product itself.
Margins.
Yes. We need to look closely at what they are selling because this is where the numbers get genuinely terrifying from a valuation perspective. Their trailing 12 months gross margin is 3.08%.
Yeah, that metric is the single biggest threat to the company's existence right now.
Just think about what a 3% margin actually means in the real world for a second. For every dollar Beyond Meat brings in from selling a burger, they only keep about 3 cents.
3 cents.
3 cents. That 3 cents has to cover the corporate salaries, the marketing budgets, the interest on their massive debt, the research and development. You literally cannot run a global consumer packaged goods business keeping 3 cents on the dollar.
You really can't. The mechanics of margin compression here are just brutal. When a company experiences a drop in sales volume, like their 11.6% revenue decline, their fixed costs don't just disappear.
Right, the factories still cost the same to run.
Exactly. The equipment leases, the base supply chain infrastructure, it all remains the same, but those costs are now spread across fewer burgers. Combine that with aggressive price cuts attempting to match traditional beef prices, and the gross margin simply collapses.
Which means all of those aggressive operating cost cuts we discussed earlier, the 60% improvement in cash burn, they're basically just temporary bandages.
Unfortunately, yes.
Yeah.
Without gross margin expansion, the math will never work long term. You cannot cost-cut your way to prosperity if your core product costs almost as much to make as you can sell it for. The fundamental unit economics just have to improve.
And that structural flaw might actually explain their next strategic move, which brings us to their emerging engine, or maybe we should call it optionality, because it is a wild pivot.
The beverage launch.
Yeah. Management is actively expanding beyond meat alternatives entirely. They are launching a new plant-based beverage called BYND Immerse.
It's definitely a swing for the fences.
When I read that in the sources, I did a double take. It feels like going to your specialized, highly trained local butcher, and suddenly he is aggressively trying to sell you his homemade sports drinks.
That is a great visual.
It just reeks of desperation to me. The beverage aisle is notoriously one of the most fiercely competitive spaces in any grocery store.
It is, but it's absolutely a pivot born of necessity. Let's analyze the strategic logic behind it for a second. If the plant-based meat category in the U.S. is saturated, suffering from brand fatigue, and trapped in a low-margin death spiral, management has to find a new category. Look at it through a valuation framework. If BYND Immerse actually gains traction, it reframes the entire equity story. Right now, Wall Street views them as a struggling, single-product commodity meat company.
Okay, I see where you're going.
Right. If they successfully launch and scale a functional beverage, management can suddenly pitch the company as a diversified plant-based nutrition platform.
And platforms get higher multiples.
Exactly. The market assigns significantly higher valuation multiples to diversified health platforms than to struggling burger companies. It is a massive capital-intensive gamble, but it is specifically designed to change the narrative.
A gamble that requires immense capital to execute, which they barely have. Surviving on a 3% margin while trying to launch a whole new beverage line requires a very long runway. We have to look at the ticking debt clock to see how much time they actually have.
The balance sheet reality is pretty stark. As of the end of June 2026, they had $171.4 million in cash and cash equivalents.
Which on its own sounds like a solid buffer to keep the lights on.
Until you flip to the liability section. They are carrying a towering $323.8 million in total debt.
So they owe nearly double they have in the bank.
Yeah. There is a slight silver lining in the capital structure, though. Their stockholders' equity actually recovered.
Wait, it was negative, right?
Yeah, it was sitting at a negative $21.1 million in March, but it bounced back to a positive $56.8 million by June. Remaining in positive equity, combined with the reverse split keeping them listed, means they maintain their access to public capital markets.
So they retain optionality if they need to issue more stock to survive.
Exactly. But Wall Street seems completely uninterested in that optionality right now. The technical and sentiment checks are overwhelmingly bearish.
Yeah, Barclays is maintaining an underweight rating with a $10 price target, which is well below where the stock is currently trading.
And even more telling is the insider market sentiment propagation ratio, or the MSPR, which is sitting at a rock-bottom negative 100.
We really need to unpack that metric, because negative 100 sounds like an arbitrary worst-case score. What does the MSPR actually measure here?
So the MSPR doesn't just track retail traders venting on internet forums. It measures the propagation of sentiment among corporate insiders and institutional money managers.
The smart money.
Right. A negative 100 means the people closest to the asset class, the executives, the heavy institutional players, the debt holders. They are universally hedging for a downside or outright dumping their positions. The institutional pessimism is just absolute.
Okay, but here's my contrarian capital protection question for you.
Yeah.
If institutional sentiment is literally maxed out on the negative side, and Wall Street analysts assume they are the walking dead, is this actually the perfect setup for a surprise rally? I mean, what terrible news is already fully priced into that $14 stock?
Institutional distressed asset investors are running that exact calculation as we speak. The heavy debt burden, heavily priced in. The double-digit revenue declines, priced in.
The 3% margin.
Fully priced in. The market expects them to fail.
So what are the analysts missing in their catalyst roadmap?
They might be ignoring the sheer velocity of that cash burn reduction we talked about earlier. Having $323 million in debt is a massive structural problem, yes. But it is only a fatal problem if the debt matures tomorrow and you have zero cash to pay it.
It's the classic difference between solvency and liquidity.
Precisely. If management continues to manage their cash burn as aggressively as they did in the first half of the year, they stretch that $171 million in the bank much further than the bearish analysts expect.
And if they prove sustained cost discipline,
They gain leverage. They can approach their creditors and restructure that debt on better terms before it matures. That's the medium-term catalyst. If they manage a successful debt refinancing, the risk profile of this company changes overnight.
that removal of near-term bankruptcy risk is the catalyst that could trigger a massive surprise rally. Okay, so we have all the pieces on the board. The crushing debt load, the razor-thin margin, the wild pivot to a new beverage, and a cash burn that is miraculously shrinking. Let's look at the actual roadmap for what happens next.
The nearest term catalyst is their Q3 2026 earnings, which are expected around November. And the guidance provided by management is grim. They are projecting only $60 to $65 million in revenue.
And that is the critical detail to watch, because Q2 revenue was $68.8 million. So management is openly guiding for a sequential decline. Not just a drop compared to last year, but a drop from the quarter they just finished.
Yeah, which illustrates how delicate the balancing act truly is. It is a literal race between their declining revenues and their aggressive cost-cutting. This tension really defines the wealth-building verdict here.
Let's get into that verdict. Based on the sources, the overall investment rating sits at a 4 out of 10, which is essentially a neutral-leaning negative. Let's examine the base case first. What could go wrong, or what does the middle of the road look like?
So in the base case, the cash burn continues to drop, extending their runway and keeping them out of bankruptcy court. However, the U.S. revenue decline continues unabated, and that 3% margin acts like a heavy anchor.
Right, preventing them from ever reaching sustainable structural profitability.
Exactly. They survive, but they become a zombie company. The reverse split keeps them listed, but it doesn't fix the underlying math. They just limp along as a highly speculative, distressed turnaround story.
Now, what about the 3 to 5 year blue sky scenario? And to be super clear with everyone listening, this is a highly optimistic scenario showing what the business could become if execution goes perfectly. It is not a prediction. But what does the math look like if management actually pulls this off?
For the blue sky scenario to materialize, a very specific chain of long-term catalysts has to hit. First, the existing engine, the U.S. revenue decline, has to hit a floor.
It doesn't need to skyrocket, right? Just stop falling.
Right. It just needs to stabilize as consumer fatigue wears off or marketing efforts counter the meat industry's lobbying. Second, those international sales in Europe and Canada must scale up significantly to carry the growth burden.
And the butcher's sports drink has to find a market.
Yes. Third, the emerging engine beyond immerse succeeds, giving them a totally new, high-margin revenue stream that isn't tied to the cultural baggage of fake meat.
Okay, and the margins.
That's the fourth and most crucial step. That production consolidation finally pays off, lifting that 3% gross margin into the double digits.
Wow, okay.
If all of that happens, they can refinance their debt from a position of strength, and they reach cash flow break-even. They transform from a distressed asset into a high-growth nutrition platform that compounds shareholder value.
It is a beautiful dream, but man, that is a massive sequence of events that have to align perfectly.
Which is why I advise focusing on a single grounding metric moving forward. Amidst all the noise about new beverages and reverse splits, the strongest long-term driver is just this. Can their operating cash flow cross the break-even line before that $171 million in the bank runs dry?
Because that is the only clock that actually matters.
Exactly.
And, that is why you should care about this deep dive, even if you never invest a single dollar in individual stocks, and even if you wouldn't be caught dead eating a plant-based burger.
It's a universal business lesson.
Completely. Beyond Meat is a real-time, high-stakes masterclass in corporate survival. We love to celebrate the disruptors and the visionaries who claim they are going to change the world, whether it's how we drive, how we communicate, or how we eat.
But when money is cheap and hype is high, those companies look invincible.
Right. Eventually, gravity takes over. The grand vision has to survive the harsh, unforgiving reality of public market balance sheets, debt maturities, and gross margins.
A visionary idea and a sustainable business model are very rarely the same thing.
Well said. Which leaves me with a final thought, something for you to mull over after you finish listening today. We've talked endlessly about the ticker symbol, BYND, the debt covenants, the cash burn. But what about the underlying mission?
Environmental side of it.
Yeah. If Beyond Meat's core premise, that plant-based resource-light protein is a strictly necessary future for a crowded, resource-constrained planet, if that is correct, but the current company is choked to death by $323 million in debt, what happens next?
That's a fascinating question.
Right. Does the mission die if the company fails? Or are we just watching a brutal financial cleansing where the idea of plant-based eating survives and flourishes in the future, but the current equity holders just happen to get wiped out in the process?
The history of capitalism is littered with pioneers who took the financial arrows in the back. Often, it's the early investors who absorb the total loss, funding all that expensive research and development, only to leave the path cleared for the second or third wave of companies to actually profit from the normalized consumer behavior.
It is definitely something to think about next time you walk past that grocery store meat aisle and see those green packages.
Absolutely.
Thank you so much for joining us on this deep dive. As a reminder, check out the StockOracle 14-day trial link in the description to run your own valuation models. Keep questioning the headlines, keep looking closely under the hood of those stock charts, and we will catch you on the next one.